2022 could be the strangest, weirdest, toughest year I can remember for investors. So in this video, I'm going to share with you the changes I'm making to my portfolio to reflect the conditions of 2022. My name's Graham Rowan. I'm the Renegade Investor. Welcome to this week's Renegade Investor Report. Please do me a favor, just hit the like button, share this with as many friends and family as you want so they can all share this information, and let's give the YouTube algorithm a little bit of stick, shall we? So before I go into the specifics of my portfolio, I really want to talk about the big picture, because what's going on in 2022? Well, the generally accepted narrative is that inflation is running riot. They're going to pull back all of the bond buying. They're going to start increasing interest rates, and this is going to cause all kinds of issues. Well, that may well be the generally accepted story. I'm not so sure, because I think there are things that are actually going to have a deflationary impact this year. So look at the fact that basic things like food and electricity and oil and petrol are going up so much in price. That's actually going to stop people spending money on other things. They're not going to have the holidays. They're not going to have the new clothes, the new cars, the new houses. I think that's going to be a dampener. And some of the indexes I'm seeing from the purchasing managers who are buying all the stuff for industry is that prices are going down in the second quarter as the supply chains do start to work things through. So it's possible that Jerome Powell was right all along and that inflation may actually be transitory. Time will tell, but I certainly don't think we're going into hyperinflation or really, really high inflation. The question, obviously, on many people's minds is, what are the central banks going to do? Well, let's not forget, this is mid-term election year in America. So they will not want riots in the streets about food prices and petrol prices doubling like we've seen in Kazakhstan, for example. They're going to want to placate the masses. And if that means that they have to hurt those with assets by putting interest rates up, supposedly to address inflation, that's what they're going to do. See, since 2008, the policies have all been in favor of the wealthy who own the assets, because all of that liquidity, all of that money printing during a period of benign inflation has been increasing asset prices. So if you already own stuff, you've got a lot wealthier in the last 12 or 13 years. Now, with inflation starting to hit the man in the street, the voter in the street, I think their approach and their priorities may change. So I think we will see an end to the bond buying. We will see some degree of interest rate hikes, but they don't want to kill the economy, because that's not a vote winner either. So I think it's quite possible they'll introduce things like price controls. Now, if you try and look for the times where price controls have worked and been successful for an economy, it's probably a bit like looking at how many countries where communism has worked. There ain't very many, but don't be surprised to see the Western economies talking about price controls on things like energy or food. This will be seen as doing something really great for the people, but it always causes distortions. You see, there's an old mantra that said that the markets can stay irrational longer than you can stay solvent. Well, I'm modifying that for the 2020s. As far as I'm concerned, the markets can stay manipulated longer than you can stay rational. I mean, have you seen how much the Fed has been buying? If you're an American, the chances are the mortgage on your home is owned by the Federal Reserve. If you're in Japan, the Bank of Japan, the central bank, owns 40% of the stock market. So how can there be ever any kind of real price discovery of what a fair price for anything is when the markets are being manipulated to this extent? So, they talk about this sort of thing happening in the crypto world. Well, it's happening everywhere. So it's really hard for us as investors to know what a fair price of anything is when it's being so manipulated. So this year, I think we're going to see continued manipulation, but with less purchases by central banks. Now, I think, that we'll see riots on the streets, as we already are. We should all be rioting on the streets about the way lying governments have taken away all our freedoms in the last 18 months of banana syndrome. And please do at least write to your MP if you're not up for rioting in the streets. We're still seeing draconian measures implemented, which will also kill economic growth and also be deflationary. So, it's hardly surprising that we're going to see this conflict, the push and pull between certain prices obviously going up, but also economic activity being suppressed. The World Bank's just come out with a very downbeat forecast of world growth this year and next year, 2023. So, don't just buy into this single narrative that everything's going the inflationary route, because that may actually prove not to be the case. So, given this environment, what am I buying? What am I holding? What am I selling? Well, I'm certainly not buying or holding any government bonds. They're all negative in terms of real rates of return. That's only going to get worse if interest rates do go up, because obviously, as you know, government bonds pay a fixed amount of money based on the interest rate when they were first launched. So if now you could go and buy a higher interest rate bond, why would you pay for that previous one? So the prices of existing bonds will come down as interest rates go up. They'll still be negative in real terms, so don't get too excited. But if you're holding bonds in your pension, now might be a good time to get rid of them. You certainly should know what's in your pension. So I'm not adding any bonds to my portfolio. What about things like that I'm reducing? Well, I think American tech shares, generally in the past, again, the narrative is they've not done that well during interest rate rises. But if you look at some of them, you look back to the Amazons and the Googles, it's not that strong a correlation. But what I'm leaning more towards is reducing my exposure to broad-based funds that go into, say, NASDAQ or US tech stocks. I'm trying to get more specific now, because if there are going to be market corrections, if there are going to be interest rate hikes or inflation, generally you'll see the whole market will tank. And what it's, I think, going to really be pay to do your research on is to be ready to go back into individual companies that you think have got the strongest story. I mean, it may be that the FANGs will just continue their inexorable rise, but maybe if you look at what's happening in some of the other sectors, the robotics, the AI, the healthcare technology, the fintechnology, financial technology, there's so many exciting companies there that I think more so than ever now, again, because of this lack of price discovery in manipulated markets, you've got to discover it for yourself. There's never been a more important time to take personal ownership of your investment decisions and to do your own research. And I'm starting to focus in on individual companies that I think I like the story of, and the people and the plans and the scaling and the momentum and the potential, rather than generically relying on some passive fund manager to make those decisions for me. So I'm getting more into specific individual companies. I'm reducing my holding of some of the broader ETFs, because I think that passive investing story that was so strong in the 2010s, I'm not convinced it's going to repeat its level of performance in the 2020s. Just again, do please press that like button. I'm sick of talking to myself on YouTube. Let's get a bit of momentum here. Let's get this in front of a few more people. Everyone that says, oh, I love your content, should be seen more. Well, I'm trying to do things differently this year. So I'm going to keep this a bit shorter, but I really need you to help get me into that algorithm by liking the video and commenting, because the question I want to ask you today is, what are you doing in 2022? What are you buying? What are you selling? What are you holding? What are you increasing? What are you decreasing? Please tell me what you're doing in the questions and the comments section below this video. So I'm looking now increasingly for things that have got an element of cash flow to them. I'm not just wanting to rely on growth. I am looking at individual private equity holdings that have the potential to create a huge growth and don't pay dividends. But I'm also, as I reduce my holdings in the broader ETFs, I'm looking for either individual shares or things like commercial property real estate investment trust, REITs, that actually pay a decent dividend. because I think cash flow is going to become more and more important. Trying to retain purchasing power in times of some inflation. I want higher income from my assets. So I'm veering more now towards value stocks. I'm veering more towards property, royalty-based stocks that pay ongoing income streams that mean you've actually got some money coming in, because obviously you've then got choices. If you don't need the cash, you can reinvest it in something else and compound it. So for example, in my crypto portfolio, I'm dollar cost averaging in each month. So I could take dividends from stocks and shares or REITs or royalty companies and invest them into cryptos, which would give me some growth, or I can use the income if I need it. So, wealth is all about choices. So if you start having one asset that generates cash that you can then invest in another asset that generates growth, then you're hitting both sides of that equation and you're making your money work a lot harder. So I'm also looking at some quite well secured loan notes that pay above inflation returns. And these days, if you're not getting 5 or 6%, you're losing money. So, you've got to examine everything in your current portfolio and say, is this making me money or losing me money in this current environment? Because the chances are something that worked 2 or 3 years ago may not be working for you today. I'm into private equity in sectors like fintech and what you might call health tech, things that are helping to automate medicine and health-related, care-related services. We have desperate staff shortages in those areas, so we definitely need more technology in those areas. I think certain companies will bounce back better if there is a correction, so I'm trying to keep some cash and some powder dry to invest in those. If there is, maybe around, people think around Q2 might be a correction in the markets. You've got to be ahead of the markets. That's a trick. So having some cash ready now would be very useful. I'm also, as I say, going into some selected crypto tokens. I've already got holdings in the big ones like Bitcoin and Ethereum, but I'm also looking at some of the upcoming ones that have got massive growth potential. I'm not betting the farm on them, but I'm part of the baby boomer generation. There's only 4% of boomers that have invested anything in cryptos. Now, if you're one of the 96%, you are certifiably insane. This is one of the biggest, most powerful, most radical, most revolutionary asset classes that has ever been. You've got to have some exposure to it. I've seen recent reports from some of the big fund managers that said their best performing funds, one of them said a 3% holding in crypto had improved overall returns by 50%. Another one said that a 5% holding in returns had improved overall portfolio performance by 65%. And 96% of you are missing out on this. So please make 2022 the year that you get into cryptos. And, blatant personal plug here, if you go to crypto20index.com, you'll see what Dee Ludlow and I are doing in that space and how we've selected what we think are the 20 best investments. But please, whatever you do something in the crypto space. You really owe it to yourself, your family, your children to have some exposure there. So my overall strategy is slightly to reduce holdings of passive ETFs, slightly to reduce my dependence on growth stocks and to move more towards income stocks, dividend stocks, commercial real estate, things that are throwing off income. I'm looking at individual plays rather than either passive thing, even some of the actively managed funds. If they've got 30, 40, you look at, Cathie Wood's ARK ETF, it's down 47% in the last 12 months. So things that were the darlings at the start of banana syndrome have crashed quite a lot in 2021 and as we head in here into 2022. So you can't be too complacent with some of these things. You've got to be on top of it. You've got to be managing it and seeing what's going on. So I'm looking at more individually selected stocks rather than relying on these generic ETFs. So finally, I want to say that a great way of learning what you should be doing is to see what the super rich are doing. So I'll pin a post on a comment on this video with a link to that. And if I can get the technology working, I'll even have a card at the end coming up to show you how to get to that. So there's some thoughts for 2022. I very much hope that you'll find that useful, and I'll talk to you again very soon. Thanks for watching.